like to welcome you all here today on behalf of the Nebraska Grazing Lands Coalition. I am Angela Redmond, and I am the Assistant Director for the Grazing Lands Coalition, and I am joined by Michelle Michelson, who is our Office Manager. She's going to help facilitate the Q&A at the end. This webinar has been made possible by the National Fish and Wildlife Foundation. It's a grant that we applied for. So at the end of this webinar today, you'll receive a confidential survey. If you could take a minute to fill that out, we would greatly appreciate it. That information allows us to do the grant reporting that we need to do to show the impact that this webinar has had and just help us to apply for future grant applications. So for those of you who are not familiar with the Nebraska Grazing Lands Coalition, we are a nonprofit organization in Nebraska, and we provide technical assistance and educational opportunities such as these to improve the grazing lands of Nebraska through land management and land stewardship. So one of those areas that we do provide educational opportunities is in the farm and ranch succession area. This topic is especially important right now because the age of Nebraska producers is getting higher. 60% of producers in Nebraska are over the age of 65. And in addition to that, it's estimated that only 50% have plans in place for the next generation. One of the reasons that number is so high is that producers never plan to retire. But unfortunately, we don't know what our future holds, and in some cases, our health can be that deciding factor and play into how that plays out. So as we make plans for the next generation, a topic that we should consider is long-term care planning, and knowing what options are available and understanding the laws around those options is important to make decisions that are right for you and your family, which brings us here today. So we have brought in Pam Olson with Pamela Olson Estate Planning, and she has been serving clients for 30 years. She's passionate about helping people care for what they have been given. Pam loves to teach and is highly engaged in multiple professional organizations. She presents at events and seminars throughout the state for organizations such as the Nebraska Grazing Lands Coalition on topics related to estate and long-term care planning. Pam lives in western Nebraska on a farm and ranch with her husband and 3 sons. When she is not at work, she enjoys spending time with her family and getting involved in church activities and leading the local 4-H club. So without further ado, welcome, Pam. I know that I am looking forward to hearing what you have to share with us today on this important topic.
Thanks, Angela, and welcome everyone. We're going to spend an hour talking about the ins and outs of long-term care planning for the attendees on this webinar. I welcome questions. So if you have a burning question that you want to place into the chat, I have my chat window open, and I know both Michelle and Angela will be also monitoring the chat also. And we'll try to answer those as we go. I'll try to save a little time at the end if there are questions as well from attendees that you want to ask at that time. Alternatively, you will see my contact information on the last slide, and I'll make sure I leave that up for a bit. So if you have questions and you want to ask later or directly to me, please don't hesitate to reach out. So we're going to start into the ins and outs of long-term care planning. And where we're going to begin is the baseline. What options do we have for purposes of paying for long-term care? And by long-term care, I mean care that I or you would need to receive in order to stay safe and well in our own homes, or that we would need at some other kind of facility, whether that's an assisted living facility or a nursing home setting. It is a great thing that medical science has advanced to the point that we can live much longer with much more serious conditions than maybe some of our ancestors were able to do. But the reality is some of the conditions with which we have to deal may require more medical intervention than we can receive in our home. So when we think about payment options, here are the categories. You can private pay, which means you fund the cost of those expenses out of your own income or your own assets. As a note here, if the care that you're receiving is in the nursing home context, the average stay in a nursing home for a Nebraska resident today is 2.3 years or 27 months. You may be above average or below average or just average, but the care cost, the average care cost per month is $7,000 to $10,000 a month. That's a staggering number when you think about trying to generate additional liquidity to pay that bill, even if you're average, right? $270,000 on average for nursing home level care. Assisted living level care is less. In-home care is also less typically. The difficulty for many of us living in rural areas, however, with in-home care is finding qualified care providers who are willing to serve us in our homes. Where I live in Banner County, my husband and I farm and ranch in Banner County. We have a population of approximately 800 people in all of Banner County. We have no services in our county, and we are one of only two unincorporated county seats in all of Nebraska. We love where we live, but it's remote-ish. And finding caregivers who are willing to drive to a remote location to provide care can be challenging where we live. And I'm sure for many of you, that's challenging as well. The flip of the challenge living in a more populated area, if you live in some areas of central or eastern Nebraska and you're in a farm and ranch context, you may have more opportunities for services in your home depending on where you're located and how accessible you are. But the difficulty you will have is that there'll be a lot of competition for services in the home. There will also be a lot of competition for services and facilities that provide the right kind of care. Where we are, we have fewer facilities to choose from. In more populated areas, you may have more facilities, but there's more competition for those spaces. So it's just something to think about on the private pay side. Another option for funding your long-term care is to utilize insurance to accomplish that. Some of the attendees on this webinar may already have long-term care insurance in place. If you do, I still want you to listen because I'm going to tell you some things you need to be making sure you know about your long-term care policy. If you don't, I want to start by telling you the difference between these two types of long-term care. Traditional long-term care insurance looks a lot like auto insurance for the nursing home or for long-term care facilities. And what I mean by that is traditional long-term care insurance is really insurance that you purchase where you pay a premium to the insurance company and hope you don't have an accident, right? You don't have a claim. And if you don't have a claim and you never draw down those benefits, then you paid for that policy, you had it as a backstop, but there's no reimbursement or recoupment for the premium that you've invested in that policy if you don't use the policy. What we have found over time in this area is that that type of traditional or first generation long-term care is actually quite difficult to underwrite for insurance companies. And insurance companies are tending to move away from that type of product into this more hybrid type product. And what I mean by hybrid long-term care insurance is that this is, instead of being a policy where you pay premium and hope you don't have a claim, the underlying policy in these hybrid products is either a life insurance contract or an annuity that you purchase. And for an additional premium, you buy the right to draw out the cash value or the death benefit on that underlying product during your lifetime for long-term care needs. This is a pretty flexible product, and the value of it really is that you're making an investment in an underlying insurance asset. If you need your investment back because of long-term care needs, you can get it. If you never use it, what is left in that product will go to the beneficiaries that you name, either on the life insurance death benefit or in an annuity benefit. It'll go to somebody else. So it's not lost money, for lack of a better way to say it. Either of these options, whichever one you might pursue, what you have to recognize is that in order to qualify for that product, you have to pass underwriting. That means you have to be healthy enough to be a good investment for the insurance company that's issuing the product. And if you get the product, here are the questions that you need to be asking, making sure you understand what it is you've purchased. First up, you need to know what your daily rate or daily benefit is. Most of these products um, give you access based on a certain amount of coverage per day. $100 a day, $200 a day, $50 a day. So you need to know what your daily benefit is. You also need to know if you can purchase or have purchased an inflation benefits rider, RIDER, inflation benefits rider. The inflation benefits rider is effectively an increase over a period of time in the daily rate that you initially purchase. So if you purchased $100 a day in coverage 20 years ago, and you have an inflation benefits rider on that product, 20 years later, what you may get is $210 a day because these products are issued at a point in time when you're relatively healthy and you may not be on claim for many, many years. And we all know the cost of services goes up over time. So that inflation benefits rider is designed to give you some additional coverage over time. The next thing you need to know is how long your contract will pay or how much it will pay over time. So if you have traditional long-term care insurance, is that an unlimited lifetime benefit, which is how these were originally marketed? Very rare to find those today. Most of the time, what you'll find is that the product will pay for you if you're in a triggering situation up to a certain amount of benefits, maybe $300,000 paid to you, or a certain period of time, 3 to 5 years, or a combination of those things. If you have a hybrid product, you may see something similar, but instead of being over a period of time, what that product may limit is how much you can pull out in a given year. And it will also limit how much of that available death benefit you can take, either per year, per incident, or over the lifetime, over your lifetime. Okay, so you need to know how much you can get out of this product. And then you need to know if there's any kind of waiver of premium that's available, right? Waiver of premium just means if you're purchasing something where you continue to pay premium, if you go on claim, does the company stop billing you for premium? And finally, you need to know what kinds of levels of care the product will cover. So in traditional long-term care insurance, it was rare to find assisted living coverage. That's changing over time, but you need to know, will that policy of insurance that you've purchased, will it cover you in-home if you can get in-home services? Will it cover you in an assisted living facility? Will it cover you in a nursing home? Where are the places it will cover you? And what kind of documentation do you need to provide to the company in order to get that coverage in place? Is there any kind of waiting period? Do you have to privately pay for some time before it will kick in? What happens with that contract? Those are the kinds of things you need to know if you're interested in long-term care insurance. Even with long-term care insurance, depending on what your prognosis is, how expensive the facility is where you are residing, you may also still come up short. If you come up short and you can't personally pay for your care, then Medicaid is the option that we look at. Medicaid, in this context, is default long-term care insurance for folks who cannot privately fund their own long-term care. And we're going to spend the majority of our time today focused on the Medicaid rules because as farm and ranch families, as ag producers with assets, we need to be careful that we understand how these rules apply to what we have accumulated. And so we're going to talk through that. And the reality is, for most people, the likelihood is that to pay for long-term care, you're going to look at a combination of two or three of these different options for a long-term care payment. So let's talk about how you can be proactive in this space. First, please be sure that you are talking about long-term care issues with your legal and investment advisors. Understanding how you're going to pay for this is an important part of how you um, steward your assets and how you think about how you're going to pass those assets over time. At base, if you have to use all your money and all your assets on long-term care, you don't have anything to pass to somebody else. And you want to be thinking about what your plan is in this space. If you're one of the folks who needs some kind of long-term care help, how are you going to pay for it? And the easiest way to come up with a plan is to do that before you need it. Okay? I mean, we all know we work better if we're not panicked or in crisis, right? So you need to be talking ahead about that. And then critically, you need to be dealing with advisors who actually know what the rules are. I am sorry to say that I deal with a lot of clients who get bad advice on these kinds of questions. They talk with somebody who thinks they know the rules and they don't. They get information that isn't correct under Nebraska law, or they get information that is correct in a different state, but not in Nebraska. Okay. And that's the other thing to know here is that the rules that we're going to talk about for purposes of Medicaid coverage are state specific. These only apply to Nebraska residents seeking Nebraska Medicaid. If you live in a different state, this is still useful. You can get some information that you can follow up with for purposes of your advisor in a different state. But recognize that the rules we're talking about today are Nebraska rules and Nebraska rules only. The other thing I want to note for you here is that it would be a mistake to think that Medicaid is only available or necessary to consider if you're poor. It's not. As I said earlier, long-term care is expensive. And the thing that farm and ranch producers often have in common is that you may have balance sheets that look asset rich, but in reality, you have liquidity light circumstances. And it's not because farmers and ranchers, ag professionals, small business owners are poor planners. It's because for most professionals in that space, when you have liquidity, you're pushing that liquidity back into the infrastructure. What do I mean by that? Simple things. So if you have liquidity, you're paying down debt. You're acquiring new updated equipment. You're expanding livestock herds. You're adding another unit of production. You're replacing a pivot, right? You're doing something with that liquidity to make the infrastructure work. And so you're reinvesting in the business, but that doesn't mean you have a pile of cash laying around because you've reinvested in the business. So as small business owners, ag professionals, these are the things we need to understand about the basic Medicaid rules. As a starting point, as I said before, we're talking Nebraska rules for Nebraska residents only. If you are in a nursing home setting and you are struggling to pay for that long-term care or an assisted living facility or at home, you need to know what Nebraska's Medicaid rules are. As an initial layer, Medicaid looks first at your physical or your medical circumstances, okay? By that I mean if you're age 65 or older, you've satisfied that criterion just by virtue of your age. If you're younger than 65, then Medicaid requires that you meet their definitions of blindness or disability in order to qualify for Medicaid. We don't have time to talk about what all of that means today, but for your purposes, understand that the delineation is 65 and older, you've satisfied that requirement. Under 65, we need to make sure you meet the medical criteria of blindness or disability. And then the other piece is, once you've checked that box, do you meet the financial criteria? So when we're thinking about financial criteria, here's what we're looking at. First, we look at income. And there are a lot of words here, but here's what income is. Income is liquidity that you receive from a source that you can't sell or turn into a pile of cash. Okay. So Social Security payments, wages that you receive, um, interest from an account that you can't cash out, some place where you get income and the source of that income is not something you can turn into a pile of cash. So if you own real estate and you are a cash rent landlord and you're getting cash rent from your real estate that you own, that's not income. Medicaid's looking at the ground. They're not looking at what you get for cash rent. Okay. So Medicaid looks at your income and then they look at your resources or your assets. I will use the word assets a lot today. Assets and resources are interchangeable for purposes of Medicaid. And resources, when Medicaid looks at whether or not you qualify for their assistance, resources are divided into two categories for Medicaid. Medicaid is only interested in your available or countable resources. There are other resources that are excluded, and Medicaid ignores them and does not care about them. But they do care about your available or your countable resources. Countable resources really are anything that you can turn into a pile of cash that is not otherwise excluded from accountability. So we're going to go through some of these categories in a minute. And I'm going to tell you what these categories are. And then we're going to talk about the why. Why does Medicaid take the position it does with regard to some of these assets? Okay. So what you see here are a sampling of the kinds of assets that can count when applying for Medicaid. Cash, savings, CDs, investment accounts, all those things that we would typically consider to be a pile of cash or a cash equivalent item, those are all on the countable list. Certain kinds of land contracts, unpaid and collectible notes and loans, your interests in LLCs, corporations, and similar entities, if we can't get them excluded, and we'll talk about how we could try to do that. If we can't get them excluded for any other reason, those entities count. Life insurance that has a cash value of more than $1,500 counts against you. Cash value is what the life insurance company will pay you to get rid of the contract. So if I have a life insurance contract and I own it and it insures my life for $300,000 and it has a cash value of $25,000. What that means is I can cancel my life insurance contract and the life insurance company doesn't have to pay that $300,000 death benefit when I die, but it has to give me $25,000 now to cancel the contract. That's what the face value or cash value in Medicaid's world is focused on. Okay. Here are some ways you can be proactive. So when you're thinking about these questions and you're getting ready to talk to an advisor or advisors about your long-term care plan, the first thing you need to do is make sure you know what you own. And we need to know what you own. We need to know what your spouse, if you have one, owns. And we need to know what the two of you own together if you own things together. We also need to know what those assets are worth. So for example, when we're thinking about real estate for farmers and ranchers, what we're concerned with there and the value Medicaid looks at for purposes of determining what ground is worth is what your county assessor says the adjusted assessed value is. So adjusted assessed value, just so we're all on the same page, when the assessor looks at your ground, they say the ground is worth this. We're going to reduce what we say the fair market value is by a certain percentage, set down to 70% of what we say it's worth, 80% of what we say it's worth. And that is your assessed value. So that's the value the assessor is going to calculate your property taxes on. Medicaid doesn't want this lower number. They want this higher number at the assessor's office. And that's what they will determine as fair market value for purposes of real estate. If you have entities, LLCs, corporations, family limited partnerships, we need to know what the operating agreements, shareholder agreements, governance documents say about those entities. If you have leases in the mix, we need to see copies of the leases. And if you've done any gifting in the recent past, we need to know what you gifted and the date it happened. Okay, those are all things you can gather in order to be proactive before you speak with an advisor about these questions. Here are the kinds of assets that Medicaid will not look at. So they will ignore these. These do not have to be considered when we talk about spend down. These do not get spent down. They're just ignored. They're excluded from countability. So real estate that the applicant or the applicant's spouse lives in and occupies is excluded as long as it has an equity value of less than $730,000. That does not mean, my husband and I live on a little farmstead in the middle of a section of ground. If that section of ground is worth less than $730,000, the section of ground is not excluded. Okay, Medicaid's not playing that game. What they are saying is in ag context, typically on average, the house plus 5 acres or the house plus however many acres your county says is necessary for an acreage out in a rural area. That's the most we get to count when we're evaluating what is worth $730,000. Tangible personal property, that means the stuff in your space, furniture, decorations, things that you use and move around when you clean your home, as long as there's nothing special in the home. If you're a collector of antiques and you've got $1 million in antiques in your house, those count against you, okay? But just normal personal property does not count against you. Certain types of pre-need funeral planning, which we'll talk about later if we can get to that in our time frame, do not count against you. One vehicle that the spouse can use to drive back and forth or uses as a home does not count against the couple. And certain retirement funds, if they're inaccessible, if you can't cash them in, then those are not countable either. Okay, those are the kinds of things that don't count in determining whether you qualify for Medicaid. Here's another thing that doesn't count, and this piece right here is very, very important. Medicaid has what we call a trade or business asset exclusion in its regulations. What that exclusion says is if there are assets used in the applicant's trade or business, and the applicant's spouse, or the applicant's parents are actively involved in the day-to-day operation of the business as that individual's primary source of income, those assets, regardless of value, will be excluded. That sounds pretty good in a farm and ranch context, except here are the wrinkles. So I'm going to use my family as an example. My husband has been back in the farm and ranch operation since 1993. 1994, since 1994. His father is still living. He's 84 years old. My husband is the primary operator in the operation at this point, but my father-in-law is still very involved in the business as far as, he's the owner of most of the assets, and he's the president of the corporation, things like that. If my father-in-law goes into the nursing home, and he has no spouse. His parents passed away many years ago. His trade or business assets, all the things he owns, count against him. And it doesn't matter that my husband is there and doing the primary labor and the work, because those business assets are only excluded if my father-in-law, his spouse doesn't have one, his parents, dead, are actively engaged in the day-to-day operation of the business. And my father-in-law in the nursing home will be determined to be de facto not actively engaged. in the business, even if he's making decisions from the nursing home, not actively engaged under Medicaid's rules. Here's another twist. What if it is the business assets that my husband and I own, and my husband goes into the nursing home? I, as his spouse, do a lot of different things on our operation. In fact, I spent all of Labor Day weekend in an AI box thawing straws while we bred cattle. That's what I did all weekend. Um, if my husband goes into the nursing home, he's not considered actively involved. I know what's going on, but I don't do the day-to-day decision making. I mean, I'm really good. I'm super good help, right? But I'm not the day-to-day decision maker. I'm not the manager of the business, and I have my own work, right? I have my own professional space. If Medicaid looked at our circumstances, they would undoubtedly not consider me to be sufficient to meet these criteria because I make more money in my own business than my tax returns say I make in the ranch business. And here's an easy example of that. I bet if I polled you all, which I won't, don't worry. If I polled you all, many of you make decisions to prepay the right kinds of inputs at the end of your tax or fiscal year so that you show little or no income for purposes of income tax returns. It's pretty normal tax planning in a farm and ranch operation to prepay so that you aren't paying income tax. Very normal. But Medicaid will look at those tax returns and say, well, you're not making anything. And if your Social Security earns more on your tax return than your operation does, it's not your primary source of income, right? So we just have to be very, very careful. You can't simply rely on this trade or business exclusion to say, we're going to be fine, because you have to meet all of the elements of this exclusion, okay? I want to talk through two common financial scenarios so you can see how this works in real life. And the reason, before I do that, one thing I want to say is this. Medicaid has all these rules. And a lot of times when I'm talking with clients and we're counseling and planning, clients will say to me, this is so unfair. I've worked all my life. Why am I losing my assets? Why do I have to spend down? This is so unfair. And I get it because these rules are harsh. But the reality is Medicaid is a taxpayer funded program. We get some of our funding from the federal government, and we get a lot of our funding from state taxes. And because these are taxpayer funded programs, that means that every person on this video webinar that pays taxes in Nebraska, some of your tax dollars are going to fund folks who cannot privately pay for their care in a nursing home. It's just part and parcel. And Medicaid says, look, if we weren't here to help with taxpayer funded dollars, every person who's coming to us for assistance would sell everything they have to avoid, to pay for nursing home care in all likelihood. We're not asking you to sell everything, but you have to show that you have financial need before we're going to give tax dollars towards your nursing home bill. And that's just the rule, okay? So the first common financial scenario is a single person, widowed, divorced, never married, who enters a nursing facility. So if I am widowed and I go to a nursing facility, the rules are very simple. I get to keep $4,000 or less in countable assets, and whatever my income is goes to the nursing home to help pay for my monthly care costs. I get a little bit of money, about $90 a month, in what's called a personal needs allowance in order to, pay for crazy stuff like a haircut or shampoo, things like that. But everything else that's income goes to the nursing home. I've applied for Medicaid because my income isn't enough to pay that nursing home cost, and Medicaid makes up the difference. So that's how it works with a single person. $4,000 or less in countable assets, the income goes to the nursing home, Medicaid makes up the difference. The other common scenario is when there's a married couple, one in the nursing home needing Medicaid assistance, one living at home without Medicaid. That's pretty normal, okay? When a married couple applies for Medicaid in Nebraska, A married couple applies under the Spousal Impoverishment Program. It's a terrible name, okay, and causes more than one client of mine some stress. The point of the name is to say, for the well spouse, the spouse that doesn't need Medicaid, we're trying not to impoverish you. That's what this goal is with this program. So to apply under this program, the couple will fill out an assessment of resources, which is a list of all the countable assets that each spouse owns individually or that they own together. So house doesn't go on the list. One vehicle does not go on the list. Personal furnishings don't go on the list. Other things, anything that counts goes on the list. Medicaid values those assets and adds them up. The community spouse, that's the person who does not need Medicaid and remains in the community. The community spouse gets to keep half of those assets. That sounds pretty good, right? But Medicaid caps the half, okay? So again, you have to have financial need. So the community spouse can keep half if the half exceeds $157,920 this year. Then the most the community spouse can keep is $157,920 in countable assets. So if the couple has $200,000 in countable assets, the community spouse keeps $100,000. If the couple has $400,000 in countable assets, the well spouse keeps $157,920. That number changes every year. Don't ask me how they calculate this stuff. It's based off of the federal percentages of the federal poverty level or multiples of it, but that's how they come up with it. If your assets are too low, so if we add everything up and you're at 31,584 or less, the community spouse keeps all the assets. The Medicaid or nursing home spouse gets to keep $4,000. The community spouse can designate or pick which assets make up that half they're entitled to keep. And then income is generally split as follows. Each spouse takes his or her own income. So if my husband goes into the nursing home and he's got Social Security of $2,000, and I've got Social Security of $3,000, his $2,000 is going to go to the nursing home. My $3,000 I keep. If we're flipped, he's got the 3,000 and I've got the 2,000, Medicaid doesn't want me to be too poor, right? Because if they let me stay at home and I get to keep my assets and stuff, but my income is too low, I'm going to be applying for food stamps, utility assistance, all kinds of different things. They don't want me to do that. So what they say is if my income as the well spouse is too low, then they will allocate enough of my husband's income to bring me up to $2,644 this year per month. Okay. If I make $10,000 a month in income, I don't get any of my husband's income. I can make as much as I want. But if my income is too low, then they'll push enough back from my husband to get me up to that number or as close to that number as I can. If between the two of us, we have a total of $2,000 in income each month, then I, as the well spouse, am going to keep the $2,000, but that's all I get. Medicaid's not going to give me extra to get me to 2644. Okay. And then whatever assets are left over after I have designated my half that I'm keeping as the well spouse, and we've put $4,000 in my husband's bank account, the rest of it has to be spent down, and Medicaid has, shockingly, rules about how that works. Okay. So before we get to how we spend down, remember this. The numbers I just gave you change every year, but at different times of the year, just to make things fun. Okay, so the housing value, a house with an equity value of up to $730,000, that usually changes effective January 1. The spousal income numbers change July 1 sometimes. They just move around. So just recognize that these change over time. And don't forget that what we're talking about, what I'm going to talk about, and what the examples I've given you are nursing home specific. There are different rules if you need Medicaid assistance in the home, and I'm going to tell you they are unfriendly. Um, if you're in assisted living, there are different rules, again, that are also unfriendly. Okay. And don't forget that there are also different rules that apply if the well spouse eventually needs to go into the nursing home or if the two spouses are going into the nursing home at the same time. So we're talking today just generally about what happens if one spouse is going into a nursing home or if a single person goes into a nursing home. That's what we're talking about today. We also need to talk about gifting. And here's the deal. As I said earlier, Medicaid is a needs-based program. In order to meet financial criteria to qualify, Medicaid doesn't want you to empty your accounts, transfer all your assets, and then say, ta-da, I qualify, pay for me in the facility. They don't want that. And so their rules are very specific. And their rules say this: if you deprive yourself of an asset and you apply for Medicaid within 5 years of that deprivation or that gift of an asset or assets, then Medicaid will punish you for having done that. Okay. So the application for Medicaid specifically says, have you or anyone on your behalf given assets away for less than fair market value in the last 60 months? You have to disclose any gifts that you have given or someone has given on your behalf. And for spouses, that includes, if I'm going into the nursing home, but my husband is giving gifts away, his gifts count against me. Same thing. Okay. If you have given gifts inside that 60-month or 5-year window, immediately preceding your Medicaid application, then Medicaid will determine how long those gifts would have paid for your care. And in Nebraska, it's a very common sense formula. Okay. So if I've given away $200,000 in value within that 5-month window, and I'm in a facility where my care costs are $10,000 a month, that $200,000 gift would have paid for my care in the facility for 20 months. When my husband and I have spent down to otherwise qualifying levels, so I've got $4,000 in a bank account, my husband has got his share of our countable assets, and the excluded assets that don't count against him have been placed in his name. When we've gotten there, and in other circumstances, Medicaid would have started paying for me, Medicaid won't for 20 months. That's all that happens. A lot of times people will say, Medicaid takes, the nursing home makes. None of that happens. Okay. It's very passive aggressive. Medicaid simply says, well, you're now at qualifying levels, but you gave away gifts in the last 5 years. So now that you're at qualifying levels, come see us in 20 months or whatever the penalty period is that's calculated. The longest penalty period I've ever seen in my career exceeded 15 years. And it had to do with a grandparent giving ranch assets to a grandson, and getting bad advice, wrong advice about how the penalty period would work. It was a very big deal. This is a very big deal. And I will tell you all what I tell every client of mine, which is this: before you apply for Medicaid, before you sign stuff and submit it, make sure you talk to someone who knows what the rules are. And I will tell you, very well-intentioned professionals in nursing facilities are not going to know these rules to this degree. I've got colleagues in the legal community who are learning, and over the last 30 years, as I've been teaching and teaching and teaching in this space, more of them know than used to. But a lot of my colleagues don't know the rules either, because this is pretty detailed, specific stuff. It is much easier to advise you for an attorney, and easier, just so you all understand, typically equals less expensive. Let's just call it as it is. It's less expensive to advise you than it is to defend you. So before you submit paperwork in a situation like this, make sure someone competent is advising you about what you need to do and what rules apply to your specific circumstances. These are the kinds of things that can constitute a gift and could trigger a penalty period if you engage in these actions within 5 years of application. You see a lot of things here. Traditional gifts, giving your son or daughter who's on your operation a deal to buy ground, um, paying now for services that were rendered years ago that were free at the time, but now you're going to pay for them. Those kinds of things are all things that can be considered a gift. And you don't want to do those things and then apply for Medicaid. Here are some planning strategies that we can look at. And I am watching the clock. I know we've got about 15 minutes left, so I'm going to move through a few of these fairly quickly and skip over some. I believe Angela and Michelle indicated that if you want the slides, I can provide a PowerPoint of the slides that can be accessible if you request it. Okay, so gifting. If you're going to do some gifting, do the gifting and then wait at least 5 years before you apply for Medicaid. There are certain kinds of deeds that we can engage in Medicaid planning. And if you have a deed that is involved in your gift, the 5-year clock starts from the date the deed is filed with the Register of Deeds, not the day the donor signed it and threw it in a desk drawer. That does not count. That doesn't start the clock. It's only the filing date that counts for clocks. You may want to consider doing a federal gift tax return, which is a 709, to document and prove the date of the gift. You don't have to, but it's an option to consider. If you want to, in a spousal situation, when we have identified what the well spouse keeps and what has to be spent down, it is acceptable under Medicaid's rules to do any of the following items, any of the things that you see here. You can do any of those things with the assets that have to be spent down. And these are not gifts and do not have to happen more than 5 years before you apply for Medicaid. Okay. Medicaid says when you're spending assets down, if you need to re-roof the house for the well spouse, do it. If you need to upgrade a vehicle, do it. If you need to do your pre-need funeral planning, that's the time to do it. Follow Medicaid's rules, but you can do that. If we do have trade or business excluded assets, if that exclusion does apply and you need to update some equipment, deal with paying off an operating note, pay down land debt, you can do all of those things as long as the trade or business exclusion actually applies to those assets. Okay. You can also do certain kinds of pre-need funeral planning, and Medicaid has a couple of options. So the first option is to do an irrevocable burial trust. That's a document that you sign at the funeral home, and you can fund that up with up to $6,507 this year. And you can do one for you and one for your spouse, each of them funded up to this amount. The irrevocable burial trust pays for the services of the funeral home, the preparation of the body, the service itself, the kinds of things the funeral director would normally do. That's what this pays for. In addition to the irrevocable burial trust, you can also pre-purchase your monument, casket, liner, and gravesite, and you can prepay opening and closing fees. If you use, instead of doing an irrevocable burial trust, Medicaid will allow you to segregate funds of up to $1,500 for the services of the funeral home, or life insurance can be irrevocably assigned for burial. The better course in most instances is this irrevocable burial trust, as long as you follow the rules. I'm going to look at the chat here. The at-home spouse can grow the assets kept since it is a one-time look. Excellent point. Excellent, excellent, excellent. Okay, so when we allocate assets to the well spouse, we change title on those assets to the well spouse. We put the $4,000 in an account for the nursing home spouse. It is important to plan for the kinds of assets we allocate to the well spouse, because as this question notes, those assets can grow once Medicaid benefits start flowing. Okay, so when the question says, it's a one-time look, that's correct. But on the date that the nursing home spouse begins receiving benefits, that's the date at which the well spouse's assets can be at or below the amount assigned to the well spouse. After Medicaid benefits start flowing, those assets assigned to the well spouse can grow. Absolutely. Okay. And we don't care anymore about that growth. Medicaid simply cares that the well spouse doesn't give any of that away. Still no gifts, but the assets can grow. So it's their strategy involved in deciding which assets we're putting in the well spouse's bucket because we want assets that are productive. Typically, we want assets that are productive. And the other question, let's see here, can funeral planning be for both the spouse at home and the one applying for Medicaid? Yes. So when we do this pre-need funeral planning, absolutely can be done for both at that time. Both are acceptable spend down of assets. Yes, you can buy a new house as long as you stay at or below that $730,000 in value, and you make sure that the well spouse who's occupying that new house can afford the property taxes and the insurance and the upkeep and things like that. Absolutely. Okay, so let's look at a few more things here. I think there are some requests for some slides. We'll get those to Angela and Michelle, and then you can work with them. Okay, this transfers to community spouses what I just said. When we're designating countable assets that go to the well spouse, we change title to the well spouse, and that's not considered a gift. There's no look back period. We also take all the excluded assets and change title on those to the well spouse. Again, not a gift, no look back. There are certain kinds of real property transfers that also are not subject to the 60-month review, okay? So for example, as I just said, we can transfer the home to the spouse who occupies it. We can also transfer the home to a child who is 20 or younger, blind or disabled, or who's been living in the home for at least 2 years before Medicaid assistance or nursing home care is sought. And we can show that residency with mom and dad, actually delayed having to move to a facility. We can also transfer it to a sibling who has an equity interest in the home, so if brother and sister bought a home together and they each contributed something to the purchase price. If the brother goes into the nursing home and the sisters lived there at least a year and she contributed something to the purchase price, we can transfer that house to the sibling without that being considered a deprivation. We can also do installment sale contracts. And these are, you have to follow Medicaid's rules if you're going to do this. But if you're in a situation where you have operational assets and you don't have another way to preserve those operational assets, you've got some real estate you want to sell to on operation kid, you can be the bank. In other words, you fund you agree to an installment arrangement where kid on operation pays a certain amount every year. That's fine as long as you follow Medicaid's rules. Okay, so the contract cannot last longer than your life expectancy under Medicaid's rules, and they think you're going to live less long than the IRS does in this context. It has to be a fair market value sale, which means minimum price is adjusted assessed value, unless we can prove through a broker's a price opinion or something else that the adjusted assessed value is too high. The installment payments have to be equal. There can be no balloon payment at the end. There has to be fair market value interest charged, and the payment cannot be canceled when the owner dies. So it has to continue to be paid, okay, until that contract is satisfied. We are going to skip over a lot of the trust issues here, but I want to highlight a couple of things, okay? First, third-party settled trusts. What this means is if I, as a parent, have a child that is disabled, in my own estate planning, I can create a trust for that disabled child, and I can fund it with my assets. And I can say inside that trust, the money I'm giving to my disabled child at my death inside this trust is not available to be used for anything Medicaid benefits will pay for. So if my disabled child is receiving Medicaid assistance to be in a group home or in facility level care, and then I pass away, with the right planning right language inside my planning, I can allocate funds for the benefit of that child without disrupting their Medicaid or their supplemental security income. And I can improve their quality of life And when that child passes away, I can direct where the funds that are left over go. Okay, is base planning. Very important to have in any kind of estate planning that you do just in general. Um, the flip of this is if I have a trust of that type, I've created a revocable or changeable trust as part of my planning, and then my husband or I need nursing home level care, assets that I own held in my revocable trust still count against me and against my husband if we need Medicaid assistance. Okay. Revocable trusts do not protect assets from the owner's from accountability if the owner needs nursing home level care. LLCs, corporations, family limited partnerships do not, generally speaking, protect those assets if the owner of the interest in the entity needs nursing home level care. There are very limited exceptions to that, which we don't have time to talk about today, but in general terms, simply creating an LLC provides no protection. Okay. I said with limited exceptions. Let's go to special needs trusts. Special needs trusts are trusts that are created for a disabled person to hold the disabled person's excess assets. That's different than a third-party settled trust. Okay. So I had a client years ago who had a diagnosis, a degenerative diagnosis, physical condition, degenerative diagnosis. Super, super bright person. Got a college degree, even as the diagnosis progressed, and took a certain amount of money that he had inherited from a grandparent and did investing on the side. Eventually, his diagnosis, his condition got to the point where he really needed Medicaid covered care. Had gotten his college degree, had a reasonable income, but given his care needs, could not accumulate any other assets. But he had this investment account that he'd grown over time, and he was super proud of it, as he should have been. That investment account would have to be liquidated and spent down before he could qualify for Medicaid, unless we utilized a special needs trust for him, which is what we did. So the special needs trust was created. He was the creator of the trust. We put his investment account inside it, and he was under 65 years of age when we did this. The trust held those funds shielded from accountability during his lifetime, so he could immediately qualify for Medicaid, and then the investment account funds were available for things that he needed extra that Medicaid didn't pay for. And when he subsequently passed away, what was left inside the special needs trust was used to pay back Medicaid for benefits that had been expended for him during his lifetime. So there's a payback clause in here. And the payback clause is there because basically it says, we'll let you qualify early, applicant, and we'll let you spend down this excess you put in the special needs trust over your lifetime. But if you didn't get it done before you die, then we paid too much in benefits. You got to pay us back. Okay, so that's what a special needs trust is. I'm not going to worry about estate recovery right now, but I am going to flip to this slide so that we have a few minutes. I think we have 2 minutes left. I'm sorry I talked too long. We have 2 minutes left. If you need that contact information, please don't hesitate to reach out to me. Angela and Michelle, I'm looking. I think I covered all the questions inside the chat. Any questions that anybody wants to raise? Okay, I think we did it. Under a minute to spare. Happy lunch.
Fantastic. Such good information, Pam. I know that I personally am living it, and I appreciate it. I think a lot of others on here will appreciate it as well. So, um, if there is no further questions, we will put up our QR code that you can use your phone to click on and go directly to our survey now if you would like to do that. Otherwise, we will be sending out a survey through the Zoom link that you've been receiving. So If there's no other questions, I guess that will end our webinar today. And thank you, Pam. I so appreciate all the information.
My pleasure.
To learn more about NGLC's mission, our scholarship opportunities, and events, please visit nebraskagrazinglands.org.